Welcome to the AGORACOM online Gold and Commodities Conference. Today we've got our keynote speaker, Barry Ritholtz. He's a fantastic guy, author of Bailout Nation. Barry, welcome to the conference.
Well, thank you, George. Thanks for that lovely intro, and it's a pleasure to be here.
Barry, you're the author of Bailout Nation, which is probably the best reviewed book on the whole bailout situation. You've had the Wall Street Journal and New York Times, Traders Almanac, a number of awards given to you because of your findings in the book. Let's talk about, before we can actually talk about what your take is on gold and commodities, let's talk about how these bailouts came about, and then let's go down that path as to where inevitably we come out. But how did these bailouts come about?
Well, people have been describing the whole collapse, the bailout situation, as a perfect storm. But I think that's really misleading. I think this is the result of many years of bad decision-making on a number of levels, both on a corporate level, on a central banker level, and on a government level. When we look at the special dispensations given to various banks and financial institutions, we discovered this wasn't a failure of regulation, and to some degree it wasn't a failure of deregulation. It was a number of companies going to Washington, D.C. and saying, we want this legislation that benefits nobody else but us, and getting it. And the great irony is all these companies that subsequently blew up, they pretty much blew up by their own doing. So a couple of favorite examples, it probably starts with Citigroup, which had been lobbying for the repeal of Glass-Steagall for more than a decade, and they finally got it in the late 90s. More or less bullied Treasury into doing it. They announced that the merger with Travelers, and that merger was technically illegal under Glass-Steagall, and they pretty much forced the Treasury Department, which previously had been run by Bob Rubin, who had just retired after Glass-Steagall was repealed, and then goes to the executive committee of Citigroup, sort of as a reward for allowing them to just become, this monster bank. That was the joke I tell is, everybody talks about too big to fail. These guys are too big to succeed. They had too many moving parts, too many divisions, too much risk going on. Nobody could keep track of it. So Citigroup asked for an exemption. They got it, the repeal of Glass-Steagall. Work your way down the list. AIG and Enron, two little companies you may be familiar with, both were very active in derivatives, and they were concerned that derivatives would be regulated pretty much the way every other financial instrument is regulated. You want to buy a stock, it's going to be traded on an exchange. The counterparty is going to be required to put up sufficient capital. There's going to be some degree of transparency. It's not going to be the Wild West. But Senator Phil Gramm from Texas, at the behest of his wife, who was on the board of directors of Enron,
right,
and some lobbyists from AIG, said, we want to pass this legislation, which was written by Enron, essentially, called the Commodities Futures Monetization Act, that essentially exempted all derivatives from any of the usual requirements that every other financial instrument has. So if you're an insurance company and you're writing a life insurance policy, you don't know when this guy or that guy is going to drop dead, but if you write 1 million policies, then the odds are, the actual aerial tables say that this percentage of people are going to meet their demise in this year, and therefore you have to have this many billions of dollars in reserve. Well, one of the things the CMFA ended up doing was exempting derivatives from any reserve requirements. So AIG got to write $3 trillion in derivative policies and reserved exactly zero for it. And by the way, they collected 0.1% fee, or $3 billion. It's a nice gig to have $3 billion roll in a year on unlimited liability and zero reserves. How could that possibly have gone wrong? So there were no exchange requirements. There was no reporting requirements. There was no counterparty requirements. There were no capital requirements. Essentially, all the usual rules that keep Wall Street operating smoothly were pulled aside, and derivatives were treated uniquely compared to every other financial instrument. So, of course, everybody pushed the envelope. Why reserve money? If AIG had a legitimately reserved money, they never could have written $3 trillion worth of derivatives. In fact, I don't think they could have written $500 billion if they had to put up a substantial reserve. They probably would have been $100 billion, $200 billion, $300 billion into it. It would have been 1% of the size it actually was, between 1 and 10%. But it never would have been in the trillions because they just didn't have, $500 billion in cash to put up and hold aside. So AIG blew themselves up through the Commodities Future Modernization Act. The next great example is the leverage rules. This is something that's been on the books since the 70s. It's called the net capitalization rule, and it limits the amount of borrowing that an investment house can do or a bank can do against its capital base. And it's 12 to 1, which sounds like a lot, but as we've seen since the 70s, there really hasn't been many failures of banks caused by excess leverage. That has been kept in check. Well, the 5 biggest investment houses, Goldman, Morgan, Merrill, Lehman, and Bear Stearns, went to the SEC in 2004, led by a guy, you might recognize his name, it's Hank Paulson, and they essentially said, look, this 12 to 1 is constraining. Some months we're over a little bit, some quarters it's a pain in the neck. Just let us waive this, and we're big boys, we'll take care of it. Sort of implying that, hey, we'll go to 13 to 1, but we won't go crazy. And they get this waiver, which ironically is called the Bear Stearns exemption because it's everybody the size of Bear Stearns or bigger, and they promptly leverage up 20, 30, 40 to 1, and then proceed to blow themselves up. So they asked for the rope, and then they hung themselves. And the great irony is all 5 of those companies no longer exist, or at least not in the fashion that they did back in 2003. Lehman, we know, is gone. Bear is now part of J.P. Morgan. Merrill Lynch is now part of Bank of America, and Morgan Stanley and Morgan Stanley and Goldman Sachs have become bank holding companies. So all the companies involved in these various special exemptions, special legislation, unique dispensations, that serve no public purpose except to give them specifically what they want, they all blew themselves up. When things were good, they were taking fat profits, big bonuses, and keeping them, and then when everything hit the fan, well, then it becomes a taxpayer's headache.
And obviously this had significant financial repercussions throughout the entire
world.
We all know that.
Massive. You not only started under Paulson and George Bush, you not only started with the massive bailout that was about $800 billion, but you started the Fed down its path of running a $3 trillion balance sheet that, truth be told, who the hell really has that sort of money to make good on all those bets other than having the printing press? So the bailouts begot the Federal Reserve, ZIRP policy, zero interest rate policy, all the quantitative easing that's been going on, all the monetary printing. The net results starting under George Bush, Bernanke, and Paulson, and ironically continuing under Barack Obama, Tim Geithner, and Bernanke, has been this massive liquidation of the system at the expense of ordinary people because the dollar bills in their wallet are just worth that much less than they were, in order to bail out not the financial system, not the banking system. We're saving individual banks to the detriment of the banking system. That's the Japanese model, which was good for a 15-year recession. The better way to do it is what the FDIC does, is it's called the Swedish model, which is the hell with the banks, save the banking system. So if you're a bank and you happen to be inept enough that you run out of money, well, fuck you, you're done. Wipe out the shareholders, fire the management, take all the assets, sell it to the highest bidder, and whatever that nets goes to the bondholders. That's what happens when a company is insolvent. The fact that it happens to be a financial company is irrelevant to the Swedish model. It's pretty irrelevant to the FDIC. Look at Washington Mutual. It's such a great example. I think it was a Thursday night they decided Washington Mutual was insolvent, and by Tuesday, all those changes I discussed were implemented, and the only difference you noted if you were a Washington Mutual cardholder is if you went to a Chase Manhattan Bank, you weren't charged the $2 fee because now Washington Mutual was part of J.P. Morgan, which also owned Chase Bank. So you end up with a very clean transition that protects both the depositors and the banking system, but pretty much says to a bank, if you're so inept, if your management is so incompetent, if you are so risk-taking that you become insolvent, essentially you're bankrupt, you're done, and we're going to turn you around really quickly. And Washington Mutual is